Yo trading family, your boy Wildcard clocking in before the coffee's even kicked in. The market's pulling a Jekyll and Hyde right now and I need you locked in. You got IBM down 25% in a single session. The ugliest day since shoulder pads and synth pop. And pre-market ASML's already up 3.47%. These two charts couldn't be a louder paired trade if they tried. That gap is the whole tape today. TV, tell me I'm not the only one staring at the screens and seeing a rotation that the rest of the tape is still sleeping on.
Quick disclaimer. Everything out of our mouths is just two guys talking markets, not a call to hit the buy button. Do your own work. But yeah, you're not wrong. The futures are flat at best, the VIX is low, and the overnight numbers look calm. Nikkei up 1.49, Hang Seng up 1.4. But under that, there's a civil war. The real tell is KOSPI screaming 6.24% higher. That's memory chips, not macro calm. IBM cratered on a pre-announced number. The sellers had 2 months to digest, and they still unloaded the whole truck. That's institutional depositioning, not a headline hiccup. And the other side of the rotation, ASML, just confirmed the CapEx story with a clean beat. Quick reminder, nothing we say here is financial advice. Always do your own research before making any trades.
That's it. IBM wasn't a surprise. They warned the street in May, and it still got skinned. That means clients aren't just pulling back on mainframe spend. They're routing those dollars straight into memory hardware. And ASML's pre-market print at 12:05. That's the confirmation the other side of the trade is alive. My TFT algo's sitting in Chubb, Eli Lilly, INSEE, so it doesn't care about this fight, but my gut call account is drooling because the rotation isn't just IBM. Salesforce, Oracle, SAP all got sold yesterday too. Enterprise software is getting punished as a group, even though the reasons are different for each name. TB, you've got AMD, and now in your wave trader algo, that's literally both sides of this trade, sitting inside your own portfolio. How are you not losing sleep?
Because the algo's rules are the algo's rules. Wave Trader holds AMD until the stop triggers or the tier flips, same with now. I don't override it based on one day's panic. But you're right that the software sell-off is bleeding into names that don't deserve it. Now is cloud-native subscription work, not mainframe services or consulting. If the market treats them like IBM, that's a mistake. The question is whether the first hour of trading cares about nuance, because it usually doesn't. The algos will spray everything with enterprise in the description at the open. I'm watching to see if now stabilizes by close. If it does, that's a potential buy in my paper account at a discount. If it doesn't, the rotation's uglier than we think.
And you know what's lighting a fire under one corner of that software space right now? White House just dropped the Gold Eagle initiative. Cyber coordination across the government. CRWD hit an all-time high yesterday while IBM was cratering. It's like the market picked one side of the software sector and said, "You're the future, you're the past." I see your wave trader screened out CRWD on volatility, but I know your gut's looking at it. You thinking that catalyst's real enough to override the ATR gate for a defined stop paper trade?
Exactly. The algo said too wild. ATR gate blocked it. But my gut book isn't bound by those rules. Gold Eagle Initiative is a clean government spend catalyst. If CRWD dips at the open on a sympathy software sell, I'm looking at entries. No bigger than my normal size, hard stop. The story's real. The semiconductor side of things, though, that's where the rotation has the most structural support. You mentioned KOSPI 6.24%. SK Hynix was up 25% yesterday. That's not speculation, that's physical demand for memory chips. EML's equipment orders are the echo of that. This isn't a software wreck that ends tomorrow, it's a multi-quarter wallet shift from legacy enterprise to hardware build-out.
Which brings us to the macro weather hanging over all of it. CPI versus Warsh. The inflation print was genuinely good. Headline, 3.5% year over year, down from 4.2, core at 2.8. Disinflation is happening. The data says it. But on the same day, Warsh was on the Hill calling inflation a tax and talking about regime change. Bond markets now pricing a 50% chance of a July rate hike. So equities cheered. CPI, bond sold off. That's a split personality. If yields keep rising, the rotation trade has a ceiling. Semis can rip, but if the discount rate keeps climbing, what happens to those future cash flow valuations? That's the finger hovering over the sell button.
You're spot on. The CPI data was clean. Core exactly in line, headline beating consensus. The disinflation thesis isn't dead, but Warsh's testimony wasn't about data. It was about credibility. The Fed's jawbone is telling the market, we will hike until you believe us. And the bond market listens more to that than to a backward looking price index. The risk is that tomorrow's PPI number comes in hot and those 50-50 July hike odds spike. Then tech gets hit and our rotation story gets tested. If PPI headline prints 0% month over month like the consensus predicts, then the Fed pause, trade gets oxygen. If it surprises, the two-speed economy gets a third gear, rising rates punishing the hardware side that's supposed to be the winner.
And we haven't even touched the earnings calendar. Today we've got Johnson & Johnson, Morgan Stanley, BlackRock. None of them are the main event. The one that matters is tomorrow, TSM and Netflix. TSM is the real referendum. If they guide strong, semi-thesis locked. If they blink, the whole KOSPI rally could reverse. And Netflix is the consumer sentiment proxy. If subscriber numbers disappoint, the two-speed economy narrative gets a consumer weakness side that none of us want. ASML already gave us the green light at pre-market, but TSM is the final exam.
Quick calendar check. Today also brought NFIB small business optimism, consensus 95.8, prior 95.3, not a market mover. China GDP missed at 4.5% versus 5.0 prior. Retail sales negative 0.1. Modest misses, markets mostly shrugged. Tomorrow's PPI is the macro centerpiece. Core PPI consensus 0.3% month over month, prior 0.4. Headline PPI consensus 0%, prior a hot 1.1. If that headline prints flat, the pipeline screams disinflation and Warsh's hawkish tone loses some teeth. If it's hot, the rotation gets harder to hold.
And speaking of rotation, let's talk sector. Scoreboard. 1 week leaderboard is a neon sign. The energy sector ETF, the energy sector is up 7.19%. Utilities up 0.86. Communication services up 0.39. Meanwhile, healthcare down 2.27. Materials down 2.58. Industrials down 2.75. That's capital fleeing cyclicals and landing hard in energy. And the utility bid says there's also a safety hand underneath. The rotation out of software is part of a bigger story. Money moving toward tangible assets, toward supply-constrained industries.
And that's where your portfolio call-out lands.
Yeah, and you need to hear this, because last time I bought the energy sector, ETF, I got burned. I bought the war premium. Straight up event bet that Iran escalation would keep crude pumping. When the peace deal headline dropped, the trade died, and I walked away with a $99 loss. I told you then I took the L clean. This time is different. The thesis isn't event-driven. The Strait of Hormuz is still mined. Tanker routes are still rerouted. Insurance costs are permanently baked in. India is reaping $40 billion in fuel export windfalls because the physical flow of crude has changed. Bloomberg, MLIV, this morning called the oil premium structural. Not cyclical, not event, structural. Trump's fee reversal takes one cost input off the table, but it doesn't unmine the strait. It doesn't reroute the tankers. It doesn't bring Iranian barrels back. The physical constraint is unchanged. So I'm going long. The energy sector, ETF, $2,000 stop at $54.30. About 5% below the open. No profit target. I'm letting it run. The supply disruption is now the baseline, not a headline that fades.
That's a clean distinction. Last time you were betting on the continuation of a specific geopolitical event. This time you're betting on the infrastructure of the oil market having permanently shifted. The stop at 5% below preserves risk management. My one question, why the energy sector ETF and not a refiner like VLO or PSX? Those names benefit from rerouted barrels regardless of where West Texas Intermediate crude settles, and they don't have contango bleed eating at them the way a crude proxy would.
Because I want the sector exposure and the dividend while I wait. I thought about USO, but the front month roll yield would bleed this trade over any multi-week hold. The energy sector, ETF, pays me to sit, and I don't want to pick winners among the refiners. If the trade is the structural disruption itself, the ETF captures the whole thing, including midstream and integrateds. I'm not trying to outsmart the trade. I'm trying to not get in my own way.
Fair enough. The bull case is clear. Energy is the leading sector on the week. Structural supply constraints don't evaporate on a single headline. Summer demand is still rising. Bear case. A hard landing recession kills demand. A genuine peace deal, unlikely, would unwind the whole trade and further rate hikes strengthen the dollar, pressuring crude. You're aware of it.
And the second-order effects are the ones that most people miss. Rerouted tankers mean refining margins explode for those who have capacity at the right ports. Midstream pipeline names benefit from higher throughput. Even if crude prices stall, the toll collectors win. That's why the sector's running, and it's not just a war bet.
One thing I want to link back, the international plumbing. Asia tonight showed KOSPI ripping, partially fueled by yen-funded flows. The USD JPY is basically flat, but the risk is that Japan intervenes to strengthen the yen. The yen carry trade unwind would hit US equities hard, especially tech. If that happens, the hardware side of our rotation gets hammered. That's the tail risk sitting on semis. It's not the base case, but you need to know it's there. The KOSPI surge is partially built on cheap yen leverage, and if the yen pops, the unwind could reverse even the strongest chip names violently.
That's the nightmare. We're watching ASML at 12:05, TSM on deck, but if the Bank of Japan steps in and the carry trade dumps, all that capital flees. The rotation from software to semis might not matter if the whole asset class gets liquidated. But base case, we hold the rotation and energy as the structural plays. Tomorrow's PPI is the next stress test. I'm watching those three. So here's what we're watching tomorrow. Number 1, ASML conference call. Any guidance on memory demand, China restrictions, that's tone setter for semis. Number 2, TSM earnings. The referendum on hardware, not just for Taiwan, but for KOSPI and SK Hynix. Number 3, PPI headline print. If it's 0% month over month, the Fed pause trade gets a breath, and yields might stop climbing. If it's hot, the rotation gets tougher. Number 4, the energy sector. ETF, stop at 54.30. If we break that, the structural premium argument takes a hit. We're not chasing noise, we're chasing structure. See you all tomorrow.